lastly, we have the 70% rule. So this is for flippers, for rehabbers. Basically means that you want to have the purchase price, so what you buy the property for. So let's say we bought it for $50,000 plus the rehab or the renovations. So let's say we estimate about $20,000 in renovations equals 70% of the value of the property. So let's just say here we've added our purchase price of 50, we've got 20 in the renovations. So that's going to come out to $70,000, which would be 70% of the value of the property. So we're trying to ideally turn around and flip this property for $100,000 because $70,000 in it, we'd have a $100,000 resale price. That's going to leave us a $30,000 profit or 30% profit margin. Now we're still going to have closing costs. So we're going to have about $30,000 of profit. Now this is, kind of our gross profit. We're still going to have closing costs when we sell the property. We might have commissions that also get factored out of this number as well. So we might end up with a lower net profit of, maybe $15,000 when it's all said and done. But again, that's why the 70% rule is there. It's to protect you so that you get your purchase price plus your renovation done for 70% of the value or less. You want this number to go down. This is kind of the ceiling. We don't want to go above 70% for the purchase price and the rehab combined. We want to leave at least a 30% buffer there that can be our profit that covers our closing costs, our commissions, and leaves us still with a profit. So the 70% rule is a good one for flippers. It's also can be used on the rental property side as well. If you want to purchase a distressed property, maybe a foreclosure, and fix it up and have some equity in the property that you could eventually capture someday if you go to sell it, but you could also then rent it out in the meantime to earn rental income. One other thing to note is we can work it backwards. So let's say we're dealing with a neighborhood where homes typically sell for, $200,000. So we're going to just multiply that by, 70% right away. So just 0.7, that's going to get us $140,000. So we know this needs to be our all-in number with our purchase price plus our renovations. So let's say that we estimate renovations to cost us $40,000. So that's for repairs. So we could just subtract that off, and that's going to leave us with that $100,000 purchase price. This is what we need to set our purchase price goal for. All right, so if you're looking at the property and it's currently listed for sale for maybe $150,000, then it's probably not going to work out. I doubt the seller is going to come all the way down to $100,000, but you might, shoot a low offer in there and see if you can get it. But if it's already a $120,000 property and you estimate it could be worth $200,000 when it's all fixed up, then you've got some room there to maybe negotiate them down to that $100,000 number. And then you've got $40,000 as your repair estimate, so you can be all in for this $140,000 number. All right, then we're going to have commissions and closing costs that are going to go on top of that. So our true net income is going to be less than the $60,000 spread that remains between these two numbers that we're selling for and what our costs are so far. But it leaves you a nice padded profit there, so you can still probably make $40,000 to $50,000 on the deal when it's all said and done.